Life is unpredictable, but how you prepare for the unexpected shouldn't be. Take ownership of your life planning with Policy Genius to help your loved ones have a financial safety net in case something happens to you. Whether to cover debts and routine expenses or even invest the money and earn interest over time. With Policy Genius, finding and buying life insurance is simple. You can compare quotes from top insurers and could find coverage that fits your needs and your budget. Plus, they offer life insurance policies starting at just $276 a year for $1 million in coverage. It's an easy way to feel good about and plan for the future. No wonder Policy Genius is the country's leading online insurance marketplace. Don't wait for life to make other plans. Protect your family today. Head to PolicyGenius.com to compare top-rated life insurance policies, get your lowest quote, and make a smart move in under 10 minutes. That's PolicyGenius.com.
Welcome to Liars, Cheats, and Thieves, and everything in between. Today's guest is Alan Schwartz, a forensic stock researcher, but I think of him more as an investigative reporter. Listen to this episode. It's got lessons for today, tomorrow, and the next day. I'm Latham Woodward, your host. Sarita Patel, my co-host, is on assignment in Chicago. She shall return next week. If you like this type of content, please like and subscribe to Liars, Cheats, and Thieves and Everything in Between channel. We appreciate it. Hi, and welcome to Liars, Cheats, and Thieves and Everything in Between. Today's guest is Alan Schwartz. Alan, welcome to the show.
Thank you. Happy to join you.
Well, I'm happy you're here. We've been working together on an outside project, let's just say that. And we've been talking about your past and all of the interesting things you've been doing. One of them was this case called Valeant Pharmaceuticals, correct?
Yes.
Well, we'll get to that in a minute. Alan, just as a brief kind of your bona fides, you're a forensic stock researcher for 17 years.
Yes.
Kind of a reporter in a way.
Yes.
And you broke the story about Valeant. What year was that?
2015.
2015. Mm-hmm. So 10 years ago.
Yep.
Okay, and you're a lifelong entrepreneur. You're now retired. That's kind of how I know you.
Yep.
And let's get into your work. Let's just start talking about what you did as a forensic researcher.
Well, I learned the art and science of sniffing out frauds in the stock market starting in the year 2000. I had a mentor in that enterprise, and most people in the public don't realize that it's possible to make money in the market if you can predict that something is going to go down in value as well as if it's going to go up in value. However, the art and science of short selling is well known by Wall Street insiders and professionals. They just rather that the public not know much about it. So it's hard to find that info generally. I had the benefit of being taught by a market pro and started investing my own money basically as a way of being able to work from home and participate in my kids' lives as they were growing up.
That's great. And you felt it was rewarding?
It was rewarding, and I also felt that it was right livelihood. It was very important to me to be on the right side of the ethical fence in pursuing livelihood. People don't understand that. A lot of times short sellers have a reputation of being the bad guys, but really the bad guys in the market are the people who are propagating lies, whether that's a lie that something is worth less than it is or it's worth more than it is. When you are propagating information that causes the gap between perception and reality to become huge, then you're in the realm of liars, cheats, and thieves.
And everything in between, right?
Yeah.
Everything in between. I've often heard in the past arguments that there's a necessary evil for the short seller. They play a market role,
yes,
and they're important. Mm-hmm. Perhaps you can explain that to the audience that perhaps doesn't understand why.
It's the job of every CEO to try to make his company's image or the perception that's held in the public as shiny as possible.
Sure.
But when you have sociopaths and psychopaths in the boardroom, there's a very, very profitable business model out of taking something that's worth nothing and making it seem like it's worth the moon and the stars. Then you're in the business of selling stock certificates, pieces of paper. This day, there's not even a certificate. It's just electrons for dollars. You're selling stock in a worthless company to the public. It goes on absolutely all the time. And the market regulators really are not in a position to be able to find these, eliminate them, and protect the public from them. There needs to be a truth teller who basically is able to go out there and say, this is worthless, stay away. And that's what the publication of the investigative short seller results in.
Okay, I get it. What is in fact a definition of a fraudulent company?
A fraudulent company, well, first of all, we're talking about publicly traded companies.
Right.
There's a relatively high standard of truthful reporting, audited annual financial reports, and quarterly unaudited but aligned with the audit, the annual audit, that are submitted to the SEC and go out to the public. And there was a law passed in, I think, around 2000, Sarbanes-Oxley, which required that the CEOs sign off on those reports and that there are criminal penalties for lying on those reports. That's a gold standard, and it's a system that's been in place since the Great Depression in the 1930s. Mm-hmm. It's resulted in more wealth for more people, probably than any other economic system on the face of the earth. And the SEC plays the role of the referees. They're basically there to kind of make sure the game is fair.
Are they the cop as well?
Well, they are, but the consequences are not commensurate with the crimes. Mm. I mean, put simply, if you stick up a 7-Eleven, great likelihood you're going to get caught, sentenced to prison, and that will be the last time you ever do that.
Right.
If you hold up the public for hundreds of millions of dollars in a stock fraud, if you're one of the few percent that actually gets caught by the SEC, most likely they'll make you sign a piece of paper promising you won't do it again and make you disgorge, 10% of the money you stole. So the consequences are just not there. And for the sociopaths and psychopaths who wind up in the boardroom, you get a lot of leverage. You get a lot of other people's money to spend and do things with. You can build a big dysfunctional organization that reflects your pathology.
Yep.
And if you steal, $1,000 from 1 million people, or $1 million from 1,000 people, the consequences just are not there like they are for holding up a 7-Eleven.
Yeah. Yeah, you very rarely hear about anyone going to prison from the C-suite. I mean, it's very unusual. And when they do, it's usually as an example, perhaps.
That's the hope.
Yeah, I mean, that's it. Mm-hmm. I mean, we'll get into the Valeant story now because it's interesting. And in this morning when we were talking, I was telling you that I'd read about it, just doing my homework here. And I was reading about Milan, what's his name, Panish, the originator for ICN with the pre-company to Valeant, and how this guy had been running scams before even Valeant was, and he had been busted, but this was before Sarbanes-Oxley, before SEC. Basically, this guy got slapped on the wrist a number of times. And then finally, you tell me the year, was it 2003 when this other fellow came in, Pearson?
Yeah, I don't actually know the history back that far because it was essentially a penny stock until 2010.
Right.
And that's when the fun really started happening.
And he's holding up a chart, which I will post on our YouTube channel, so take a look at that when you get a chance. Yeah, I mean, I just thought it was funny to see the decades-long scam was prior to the actual big scam, let's call it.
That's true in this case, but not a necessary condition. Once you have a bad actor, you can take over a perfectly innocuous little company and take it over to the dark side.
Right. Well, for those of you who are wondering why we're bringing up something that came up in 2015, that originated in 2015, it's because I think what you're seeing now is a real effort to weed out fraud. Not only just stock fraud, but you're seeing it in every way, shape, and form in today's life and society. So I view this as still a very, pertinent subject by today's standards. People need to know that these things occur. And if I'm not wrong, Alan, the rules in 2015 to today, they're very similar. Have there been more regulations put in place since this?
There have not. The rules are very similar. Life is very difficult for short sellers. The economic model has been almost completely destroyed. And now in the current climate, it's really unclear what's going to happen to the SEC in terms of its regulatory role. A lot of government agencies are very bloated. They're very inefficient. They've been, embedded in career building for a really long time. But in the absence of having a new and better referee in the field, it's not clear what's going to happen with agencies like the SEC in the in the current administration and beyond.
Yeah.
If they lose their entire intellectual capital of what actually maintains the rule base of what works and what doesn't, it's pretty much going to be open season.
Well, that's what we saw before Sarbanes-Oxley.
Yeah.
And I read a lot about that, and it just seems like it was open territory to scam anybody you wanted. Every
conservative politician at the national level agenda is being driven by essentially unlimited amounts of money trying to get Sarbanes-Oxley repealed.
Wow. That would be bad for the consumer.
I think it would.
Yeah. I mean, I think Sarbanes-Oxley was clearly instituted to give equal footing to the mom and pop.
And if you look at the amount of wealth that's been created and the distribution of that wealth, over the last 20, 40 years, relatively speaking, it's the envy of the world.
Yeah. Yeah. It is. I mean, where else are you going to invest your money? Right.
Well, there's real estate, but you can't be on the short side of real estate. In other words, if you think real estate is in a bubble and you're willing to put your money behind that opinion, there's no action that you can take. You can sell your house and live as a renter.
Unless you're investing in collection agencies, right?
That's what happens to all the mortgage brokers when the tide turns.
Right.
They all become foreclosers.
They have a new desk.
Right.
Yeah, somewhere. All right. Well, let's get into the Valeant story.
Yeah.
And just start us at the beginning, and let's just roll right on through, and I'll interject occasionally.
Sure. Well, you were talking about the deep beginning, and that was way before my time. But I got involved in Valeant in 2014 when it was in the middle of its moonshot.
Okay.
And short sellers become interested when it seems like a story is too good to be true. Sometimes the story is that good. But if it's not, there may be fun and profit in figuring out why that story is too good to be true. In the case of Valeant, once Pearson had taken over as CEO, he became the golden child of about a dozen hedge fund managers. Because whatever it was he was doing with that company, there's a mantra on Wall Street called beat and raise. Beat and raise. You report your quarter, you beat the estimates, and you raise the estimates for the next quarter. And if you can do that often enough, your stock is going to go up. Now, it takes a ever-expanding flow of profits to do that, and it takes being able to outperform the models that the analysts are creating for your company to do that. So Valeant developed a kind of extraordinary strategy for doing this. Pearson's belief was that R&D in the pharma industry is basically wasted money. So he wanted to buy companies that had drugs that were in the pipeline, or the companies that owned drugs that were in the pipeline.
Okay, so let me stop you there. So my reading was, and I did not know this, because a drug patent runs for 20 years.
Yes.
More or less, right? But what most people don't know, that patent is it's not when it goes to market. It starts when you can quantify your start date of development. Is that correct? So your lifespan of a patent of a drug could be as low as 4 years once it gets to market.
It can be frequently, you may see companies that have an 8-year runway, a 10-year runway, a 12-year runway. There are various strategies for how you'd extend that if you're a legitimate pharmaceutical company. But the point you're making is correct, in that it's a high-stakes bet. It's a long-term bet. It's really hard to bring new drugs to market, and the pharma industry is frequently criticized because the drugs they bring to market are the ones with the highest profit potential, not necessarily the most benefit in terms of human health.
The best ones don't always win. The best ones financially do win.
Correct. The ones that people have to take on subscription for the rest of their life are extremely profitable.
Yeah. Well, okay, continue your thoughts.
Okay, so Pearson's Valeant was executing what's called a roll-up strategy. And a roll-up...
Oh, okay, so wait, we have to back up on Pearson and his background, because I find this fascinating. He was a McKinsey guy, right?
He was a McKinsey guy, yeah.
So basically a, what do they call those guys? Consultant, right?
Yeah.
So he's a high-paid business consultant who really knows the dirt on any company they go into once they do analysis. Okay, so I think that's a very key point in Pearson's personality.
True. Useful.
Oh, sorry to interrupt again. Go ahead.
This impressed upon him the utter futility of, I put that in quotes, of research and development in the pharmaceutical business. And he was looking for an opportunity to try his brand of monetizing, which was essentially a form of the pirate ship of pharma. He would sail in and he would buy your company. He would fire all the scientists, all the R&D people on day one. And also on day one, he would raise the price of your drug 500 to 1,000% or more, whatever he felt the market could bear. And the floodgates would open of a tremendous amount of profit coming in while costs had been slashed. This would generate cash flow, and he would beat and raise. Then he would turn around and do it again. So when you have a roll-up, you have a company that is acquired. It's like Pac-Man. It has to acquire to survive. It has to buy newer and larger companies with more drugs in the pipeline, or more cash flow based on drugs in the pipeline, in order to survive. That becomes the business model itself. And these acquisitions are funded on debt. The market was starting to take notice. It made other companies want to acquire other companies, so the price of pharma companies that were for sale was running up. But it was his business model. He had to pay up, and he had to keep acquiring them, because as soon as he had a quarter where he didn't have something new in his pipeline that he was selling for vastly higher prices than it had the month before, the quarter before, his financial results would fall over.
In this acquisition period, though, other pharma companies raising in value, this just made his hedge fund bros even happier, right?
They just saw beat and raise,
right,
and were happy to provide the facilities, the lending facility. He was borrowing, $3-5 billion at a clip.
Wow.
To take over these companies. And, when you create a stock chart like Mount Everest, at least one side of Mount Everest, your hedge fund bros are really happy. That the dozen or so hedge fund bros who were in Valeant were seriously over-allocated. These guys all have concentration limits that they're supposed to live by. And a lot of them were way, way out over their skis in Valeant because it never missed. It was like the golden goose.
Right. And quantify that, though. So how much in assets should they have in any category? Like 20%, 30% max?
It depends on the rules of the hedge fund, but 3 or 4 is a lot.
Wow, 3 or 4%.
Yeah. That way you've got some kind of diversification, and your investor's money is subject to a safer ride.
Right. Of course. You're spreading the load.
You're spreading the risk.
Yeah. Okay. So continue.
Okay. The rate at which Valeant was growing, it was on a trajectory. First of all, at the time that we got involved and published on it, its market cap was $90 billion. Now, it wasn't a household name. It wasn't owned by, Joe and Mary at the corner. It was owned by these hedge fund guys. But compare it to Enron, which, it was a decade earlier and the dollar was worth a little more. But when Enron collapsed, its maximum net worth was $70 billion. So this is a big fraud. $90 billion is, the number of shares times the price per share. That represents a lot of money.
It's monumental.
Yeah.
I mean, it's crazy how much money.
Now we're a decade later, and the U.S. stock market has been taken over by, the Magnificent Seven, these 7 great monopolies. And now you have trillion-dollar companies. That was unheard of before 2000 and 18
that's
or
just because of
2020.
consolidation and acquisitions.
Yeah, and the rules have been set up so that we have monopolies, and I hope at some point you'll have Cory Doctorow on, and he can explain the mechanism by which we have the Magnificent Seven that are worth $1 trillion each.
We recently had a show on the West Marin farmers, and we were just talking about dairy farmers, for instance, and how in the United States now there used to be thousands and thousands of dairy farms across the country.
Right.
We have 3 companies basically control all dairy in this country
Right.
now. It's insanity. And how we got here, I don't know, but we have to backpedal a little bit.
Yeah.
Go ahead.
In the age, a $90 billion company was a big deal.
Yeah.
And Valeant was on its juggernaut. So we knew that the balance sheet was bad. There was way too much debt. And we knew that it couldn't survive even a quarter or two unless it had just bought something else or was just about to buy something else, because it was kind of like a vampire. It needed these new acquisitions that it could jam the prices to the moon on and monetize very, very quickly.
And don't forget firing everyone.
That drives the costs way down.
Right.
So in September of 2015, we published on Valeant, and it was the moral outrage angle. This is really, really wrong. This is a terrible thing. Congress should subpoena these people. It did nothing, absolutely nothing to the stock. Because
nothing. Zero.
No, because 12 hedge fund guys owned the whole thing. They knew it was evil empire stuff, but they were laughing all the way to the bank. We published again later in September about Valeant's accounting. We showed that if, except for the acquisition that they had just made, that they were reporting on for the last half of the last quarter that they had just reported, they would have missed. They would have missed their estimates, because once they have drugs in their portfolio for a while, the market figures it out, and other drugs and the people adjust and generics come out, and what they were doing is completely unsustainable. And we published a really good piece on a forensic analysis of their previous quarter and what would have happened if they hadn't closed their last acquisition. Goldman Sachs raised estimates. We just got run over. Market paid no attention.
Now, it was that part and parcel because of
everybody loves a winner.
Yeah, and your partner's status as a short seller.
It's hard to know when a story ripens, when it becomes time.
Right.
It's hard to know. But my partner was absolutely beside himself that we had published on this twice, and nobody took it seriously. And he was like in in a tantrum one day on the phone, and it was like, I'm never going to write a part 2 about a company ever again, and if they don't get it, the hell with them, and I'm moving on. And finally he calmed down, and I said, what would it take to actually stop this juggernaut? I mean, at the time, Valeant was so big, the trajectory they were on, they were going to acquire Pfizer probably in the next 18 months. That was going to be the end of U.S. pharma and the end of research and development in the United States. They were going to have proved that the model of researching and using scientists to create new drugs was dead. It was dangerous. It was really, really dangerous.
So this is the same Pfizer. Let make everyone know.
Yeah.
This same Pfizer with COVID drugs and everything else. The massive company. This company that was at one time a penny stock was going to buy Pfizer.
Was going to buy Pfizer.
Incredible.
Take them out. Fire all the R&D. Do the same thing. Yeah.
Incredible.
So once he calmed down from his tantrum, he said, I need a piece of information that can be proved by anybody. It can be replicated by anybody that will prove definitively that the CEO, Pearson, is lying to the 12 hedge fund guys who own all the stock. Not that he's breaking the law, not that he's doing something morally repugnant, but that he's lying to his 12 hedge fund guys.
He's lying.
If you can find me that, we'll publish it. And it'll pull the pin out of the grenade. And sure enough, there were a few short sellers who were starting to get the story at this point. There were a bunch of us working. It was like Gulliver and the Lilliputians. We were getting threads and we were pulling on them, and it was starting to become clear. And sitting in front of my screen, this rarely happens when you're a short seller, I actually found the smoking gun one day on a Google search.
On a Google search.
On a Google search. But the fraud that was being perpetrated at the time, it sounds crazy in retrospect, was a toenail fungus drug.
Okay.
How the hell can you float a $90 billion company on a toenail fungus drug? I'll tell you. If you watch the 2015 Super Bowl, the Super Bowl is sort of like the red carpet moment for next year's TV commercials.
Correct.
Right?
Correct.
All the most creative ads for beer, for pickup trucks, and for salty, crispy things get trotted out in the Super Bowl. So you're sitting there watching the Super Bowl, and it's the third quarter, and suddenly there's this little cartoon of a toe, and the toe's wearing a football helmet, and it's all done in purple, and he's talking real fast, and he's hyping this thing called Jublia. Nobody knows what the hell Jublia is. Jublia. Nobody knows that toenail fungus is a problem, right?
Very out of place for a Super Bowl.
Completely out of context. But what you wouldn't know, unless you got curious about toenail fungus, is that the entire internet presence for toenail fungus had been bought. Any search that you did, any doctor that you asked, basically a coupon had been placed in every general practitioner's, podiatrist, and chiropractor office around the country with an 800 number, and the little toenail guy with the football helmet cartoon and the purple themed graphics. Call this 800 number and we'll take care of your toenail fungus. Every search that you did, including, is Jublia a scam? Or is there something I should know about toenail fungus medicines that I shouldn't trust? It would all be captured by the umbrella strategy that Valeant had put in place.
Algorithmic grab. They grabbed
they
every
got it
term.
all. Mm-hmm.
Wow.
And they would funnel you either through a doctor or through an independent inquiry to an 800 number where you were going to get for free medicine that was going to cure your toenail fungus.
Right.
What was not told to the public was that all you really need to cure toenail fungus is patience and a $4 jar of mentholated Vaseline. The U.S. Navy had proved that there was 26% efficacy of being able to cure toenail fungus with a $4 jar of Vaseline. But that's not the FDA's job. Somebody put forth a medication. They produced a scientific test. It said it had 18% efficacy. That was compared to the mentholated Vaseline, 26%. But the FDA couldn't say it didn't work, so they gave them a license. And the FDA then is not involved in what's the cost-benefit analysis of that sale.
Now, this is where you've recounted the story to me before, and this is where it gets really interesting to me. What was the cost of that drug?
The cost of that drug was a 9-month subscription. They would send you a vial every month, and fulfilling it for 9 months cost your insurance company $60,000 per prescription.
So $6,600 a month,
Yep.
$6,500 a month.
Month for 9 months. Mm-hmm.
You've got to be kidding me.
Now, the health insurance company companies are set up to prevent this kind of thing from happening with a mechanism called copay.
Right.
You pay 10% or you pay 20%. Unbeknownst to the public, the 800 number led to a single-purpose pharmacy that was actually owned and operated by Valeant. It was a Valeant puppet that was put in place just to fulfill Jubilee prescriptions.
And what was the name of that pharmacy?
It was called Philidor.
Okay, and I think you and I
18th century chess strategy.
Yeah, and
from a guy who's smarter than everyone.
Yeah, they had bought it. Valeant had bought the pharmacy for some millions of dollars.
And basically set it up.
And then with a basically provision was there. They owned it still. Philidor owned itself, but Valeant had an option then
to buy for $1. Yeah.
I mean, it's ridiculous.
You have to understand, this is not a retail pharmacy like you and I think of a pharmacy. This was a nondescript brick building in Horsham, Pennsylvania, with a big sales staff on telephones.
Yeah.
So when a physician put in a prescription for toenail fungus med, if he happened to check, it's okay to substitute with generic. A concierge, so-called, had to call up that physician and say, no, this 800 number and this free deal it's going to cost your patient more to do a generic. So do we have your permission to uncheck that box? And they'd say yes, and they'd process it as a $60,000 prescription. Now, that in and of itself was fraudulent.
That's a classic fraud.
Yeah. But in any event, the 99.999% profit model of that prescription made it financially viable for there to be a concierge to handle every single one of them and submit it to a pharmacy benefit manager or to Medicare or whoever for payment. And after a few months of this, some of the pharmacy benefit managers started wondering why they were paying these $60,000 prescriptions, all from the same pharmacy, right? So in order to hide its tracks, Philidor bought a collection of essentially zombie pharmacies, failing pharmacies in strip malls in various states. All they had was a license.
Right.
And when the prescription would be rejected coming from Philidor, they would simply resubmit it from one of these little pharmacies that nobody had ever heard of.
Bill and Ted's in Tucson, Arizona.
Exactly. Now, each of those little pharmacies had a website, and they had all been made over by the same person. So there was a homepage with a logo and no information. They were really into black and gold. And the only page you could get to from the homepage was the HIPAA statement, personal privacy of medical records.
Correct,
right? And at the bottom of that HIPAA statement was a number. And I noticed 3 or 4 of these zombie pharmacies on this HIPAA statement, it was the same number. And I thought, that's weird. You know, Bill and Ted's pharmacy in
Arizona.
In Arizona, and Sally's drugs in Corpus Christi had the same number for their HIPAA officer. How could that be? So I called the number, and it rang through to Valeant.
And they announced themselves as Valeant.
It went right through. Somebody picked up the phone and said, you've reached the office of so-and-so, Valeant Pharmaceuticals. Leave a message.
Well, that was an oversight on their fraud.
Yeah, that was major oversight. Not
up.
Only was it an oversight, but it was publicly available, and it could easily be replicated by anybody.
Sure.
I had hit the the information lottery of how to pull the thread on a fraud.
How in the world, after they have been so careful about getting all of this stuff cloaked, right? Did they screw that up?
They weren't all that careful.
Okay.
They had left a trail of a lot of misdeeds behind, including failing to get licensing in certain states. The pharmacy benefit managers knew that something's. They had left reality behind a couple of acquisitions ago, and we're off in a world where they were so drunk on their own success that it was bound to fail. It's just that my fingers kind of got there first.
Well, in the popular movie, The Wolf of Wall Street, have you ever
Yes.
seen that? Okay, and I can't remember I've heard the author speak a couple of times.
Jordan Belfort.
Very hyper intelligent fellow.
Yeah, very charismatic.
Very charismatic, and you can see how he got where he wanted to be. You know, but at that time, which I lived through as well, they got a lot of stupid people to do their bidding, and it seemed like they had an army of patsies. And is that kind of where this was going? Is like pay them big money, just say sit in this desk and answer these questions, and boom, you're going to get paid big.
Yep, all of that.
Right. So it's always there's the complicity of the ignorant.
So my partner, published on his blog. This is the pharmaceutical version of Enron, and here's the 800 number, and call it yourself, and try explaining why this little pharmacy in Bumpkinville, Texas, is ringing through to Valeant for its HIPAA compliance. So we published it on our Wednesday.
And that's the smoking gun, the proverbial
that was
smoking
the
gun.
proverbial smoking gun, because that was the piece of information that was going to prove that the CEO was lying to the 10 hedge fund guys, that this was not a sustainable business model. And if you pulled on this thread, the whole sweater was going to unravel.
Right.
And that's literally what happened. The stock didn't react right away, but the next day it started to go down. And the more it went down, the faster it was going down. And pretty soon, throughout the day Thursday, it was in free fall. And by Friday morning, it had been the biggest loser on the exchange on Thursday. And CNBC was covering it as a lead story. David Faber, who I have a lot of respect for, is one of the smartest guys on CNBC. He was literally stammering because he can't repeat a short seller's allegations. He's just trying to, piece it together. But he was stammering so bad, he called Philidor a drug rather than a pharmacy. Wow. You can see this clip. Netflix did a really good 1 hour documentary on this story, and that clip of what was happening to the stock with the big chart with a big red down arrow behind him, and him trying to tell report on what's going on, is sort of the climactic point of the story. And it was, of course, those findings and that publication 2 days before that caused it to happen. That caused the stock. The stock basically went from 250 a share to 100 a share. That forced out a lot of selling. The CEO had shares on margin, and a lot of the hedge funds who are over levered took a real pounding. They were really over levered once it fell out of bed.
So the to use your proverb, you started the little tiny pebble at the top of the hill rolling down, and it just gathered moss as it rolled, right? I mean, it just picked up everybody. Now, during that period of time, did you and your business partner, were there any threats coming toward you?
No, it was a kinder time. My partner had pretty thick skin, and people would call him up and yell at him all the time. But we were not in an era of, doxing your family and that kind of stuff.
Right.
That kind of stuff wasn't happening. But what the press picked up on, because they love to personalize these things, it was like Bill Ackman versus the sort of mousy-looking hedge fund guy, right? My partner, Andrew Left, who was the one who published this story, used to go on Bloomberg TV and CNBC and, throw a few rocks and try to gore a few sacred oxes a few months, just as a kind of reality check on the market. Invest cautiously and think twice before you believe somebody's story. And the spokesman for the hedge fund guy is Bill Ackman. Made bazillions, really charismatic and Yale degree and really good looking, and comes on every 6 or 12 months with another fabulous idea, and is one of these oligarchs who's now running the country.
Right.
So popular press wanted to make it into Bill Ackman versus Andrew Left, right? And Ackman doubled down when the stock got to 100. He said, "I believe in this company. There's something really good in here. I'm buying up all the stock I can get my hands on. I'm going on the board. We are going to fix this and turn this thing around."
And Pearson was still there? There was no...
Yeah, he had to go on medical leave. He got really sick, and he was out of the picture for a few months. He did come back.
Prior to the fall, or...?
While it was falling. Go figure.
Go figure. Huh.
I don't know whether it was financial illness or what. But and when they'd interview Andrew and say, "Well, you got one over on Bill Ackman, didn't you?" And blah, blah, blah. And Andrew would just say, "Well, he's got really good hair."
There you go.
That was his only...
Soft-spoken.
Made his dollar, moving on.
Right.
Not trying to get a pound of flesh out of anybody. So that was really just the beginning of the collapse. Valeant went to 10, it went to 3.
3.
And Ackman, lost massively from his double down point, from the the $100 shoulder that put in where the stock first bounced.
Now, why was Ackman so... Was he just being sold a bill of goods? What was the motivation there? Was there...
Hard to say. I mean, he's always been very convincing. But his track record is only about half right.
Yeah.
He's been right a lot and he's been wrong a lot. But he's always had high conviction. So, maybe there was some ego that was involved. Maybe he really believed the Kool-Aid that they were all drinking. But a roll-up that's based on so much debt like that, once the dominoes start to fall, the whole thing happens in reverse. Roll-ups are not very popular on Wall Street anymore. They had an era where they were very, very popular.
Okay.
But unless you can...
Let's define the roll-up.
Sure.
People don't know what a roll-up is.
Okay. You're growing a company at hyperspeed by buying other companies and folding them in.
We've talked about that.
Yeah. That's what a roll-up is. If your strategy is based on synergy, you're actually able to make more than you did before. That's a reason to roll up. In the internet space, companies are very famous for buying competitors. Apple, Facebook, Google. They buy startup companies that actually pose a threat to them.
Yeah.
Mark Zuckerberg is on trial right now for doing that very thing and for writing memos that is what he was doing.
Buy and bury.
Yeah. And so it by no means dooms you to failure, but when you get so far off your skis that you're doing something like Jubilee, a $60,000 toenail fungus medicine, that was doomed. That was doomed to roll over.
And just to get the picture here too, one of the very interesting points you said, again, I'm just reiterate, the science guys, all the R&D guys, this is a major part of the strategy to get rid of the brains in this thing. And I had mentioned to you the other day when we were pre-talking this was, I feel it's like you're getting rid of the experts in the house.
Yeah, so and all the costs.
Yeah, so nobody can say anything about what you're doing.
Right.
There's no evidence there because no one's present to present the evidence. And all the costs, all those R&D guys who were probably paid pretty well, they're all gone.
Pearson was famous. The first time Ackman went to see him for lunch, and Pearson ordered out sandwiches, and he told Bill Ackman that'll be $20. He was famous for not spending, for being really tight with money.
Wow.
He wanted the hedge fund guys to know, I'm not living high on the hog off of you. I'm in this to pile up the loot.
Now, that being said, he did have a $1.3 billion option, I think, or more, or it was a bonus. I can't remember which it was.
And there was a Gulfstream.
Yeah, I mean, so he did pretty well.
Money
for a while.
A lot of money, and I'm talking now when you get in 9 digits and 10 digits of money. I believe it's toxic. I believe that for most of the guys who achieve that degree of wealth, within a few years, something really toxic, in a lot of cases pathological, begins to happen, and judgment and groundedness seems to disappear.
Okay, before we get more into the psychopathy and the and in the C-suite, what happened to Michael Pearson?
He did some jail time.
A long time, or
I can't remember. It was a couple of years or something.
Enough.
Yeah.
Maybe not enough.
I don't know. I'm sure there's a level of money that he got away with that nobody in the public will know, because offshoring and tax havens and taking care of your living trusts and taking care of your
houses
offspring
for
and all of that.
Right.
That's a well-worn path. And if you had to factor in the per hour cost of his time away from home, he was still being compensated, royally on a per hour basis.
Very handsomely, even in prison grays.
Yeah.
Well, that's too bad.
Yeah. Very, very few of these guys. I mean, we reported out 150 companies over about 15 years.
Wow.
This was the biggest. 50 of them, some real consequences happened. Either they declared bankruptcy or were forced into bankruptcy by creditors. The FBI showed up and took the CEO away in handcuffs. The Congress sent him a Wells notice. The SEC delisted him. Some kind of real-world consequence that's not just a short seller tattling on you.
Right.
Over 50 times. Very few of those guys ever actually went to jail.
So, moralistically, like in other cases you've looked at, right? Was this the worst, or are there others from a purely like traditional moral standpoint where things were just like, holy shit, I can't believe this guy was preying on widows?
Well, there was a penny stock company once upon a time that published a press release that they had a cure for AIDS. And the cure for AIDS was that it was a regimen of supplements that they were giving to mice. Mm-hmm. And they cured them of AIDS. And, of course, it caused this penny stock to go insane. Well, mice don't get AIDS. So
what was it curing?
It wasn't curing anything, of course. But
toenail fungus.
The point is that the PR on the face of it was an abject lie. This company was also running a so-called cancer clinic in Tijuana, where you could get an unconventional treatment if you were really desperate. That, of course, had no medical background behind it. I mean, these are really morally reprehensible things to do to people who are struggling with cancer diagnoses.
Right. That's pretty morally.
That was pretty
correct.
bad. Yeah.
All right. Well, let's save that for another day.
Sure.
But in closing, I just want to talk a little bit about the subject of psychopathy and sociopaths in the C-suite, because that is not yesterday or today. It's every day.
Right.
Right. And so I think it's like for people who are listening, you should understand the psychology when someone who... Now, I'm a former CFO and CEO. I never thought I was a psychopath or a sociopath.
Right. Let's be clear. The vast majority of people in C-suites are trying to do some version or another of the best they can for their shareholders, their employees, and their customers.
Right.
This is not some wild-ass claim that everybody in C-suite is a psychopath or a sociopath. But I've heard that there are studies that estimate that the concentration of psychopaths and sociopaths in C-suites is about 10x the normal population.
Wow, that is significant.
There's a lot out there. And the reason for that is they it's like, why do whales swim north to Alaska? Because they can eat there. People go where there's opportunity, and the C-suite presents a tremendous opportunity to, deploy a lot of money with a lot of leverage to create a toxic or dysfunctional organization of people around you doing your bidding, and very, very scant consequences for misbehavior.
Open territory for misdeeds. Right.
The ironic thing is that the book that I adore on this subject is a trade paperback that's 20, 25 years out of print that you can still buy at a Libris for $4, called Rampaging Bulls. And it's told in a very funny, lightheaded sort of aggregate nonfiction style about a theoretical character named Bob Holstein, who's the sociopath.
Holstein, great.
Yeah.
Rampaging Bull.
Exactly. Anyway, if you ever find a copy of it, the pages are all yellowed, and it's been out of print for 20, 30 years. But it just lays the whole thing out. Why do sociopaths wind up in boardrooms, and what do they do? The fact is, there's only a certain number of ways to do stock fraud. There's about 6 or 8 basic strategies. And these guys know them, and they do them, and they roll from one to the next and the next.
I was reading about the 7 or 8 methods. Transparently has a great outline on those 7 methods of where you can address this. And it's pretty interesting. I do encourage our audience to go out there and look at those for yourself and see what you can find for more information.
But the main thing, and the lesson number 1 that was taught to me by my mentor was, if it sounds too good to be true, it probably is. If you're reading about it in financial press and it's anything other than the actual facts, the on-the-ground tacks and nails of the fact, it was written by somebody and it has an agenda. And just like news always has an agenda, financial news has an agenda. And that agenda is to get the public separated from their dollars and to buy these stocks.
Well, one of the quotes we have on this channel is, the truth is always very simple. And that's a good lesson to learn in life in general. If you're younger and you're listening to this, the truth is always easy.
Yeah.
And it comes out very quickly, and it's like a lack of embellishment.
And there's only one story.
Only one story, and it happens very easily. The frauds, the too good to be true stories are always very elaborate. I've noticed that myself, and we've talked about that on this show. But,
Jim Chanos was probably the most famous short seller. He's really a legend in his own time. And people say, well, what interests you? And he goes, fads, frauds, and failures. And, every few years we get a wave of fad. There's an enormous amount of money made and then 10 times more lost on marijuana stocks.
Oh, yeah.
Right? Before that, it was 3D printing.
And now it's AI.
Well, quantum computing has just gone through.
Quantum computing, yeah, exactly.
Right, one of those bubbles. Some billions or maybe trillions is going to be made on AI. It's not clear yet who's going to make it.
But it's probably story. 3 or 4 people.
But yeah.
It's not going to be
the
everyone.
wealth is so concentrated, it isn't going to be everyone. No. In 2000, Internet 1.0, they invented an alternate currency, right? It was eyeballs. All you needed to get $1 billion valuation for a company was some eyeballs. You could show that your eyeballs were growing, right? Your clicks were growing. Nobody yet discovered click fraud, right?
Right.
So there was an alternate currency that created, billions overnight on paper. And there's always one of these things running through. One of the best books ever on the stock market is 100 years old. It's called Reminiscences of a Stock Operator, Edmund Lefevre.
Oh, my God. Right before the Great Fall.
Yeah. And he is a great writer, and he made and lost a number of fortunes over the course of the teens, the 20s, the 30s, and the 40s. First description of a bucket shop, which has become a term of art in the investment business. The most amazing thing about that book is that so much of it that he's describing hasn't changed in 100 years. They had telephone companies and railroads then, and now we have internet companies. But the mechanism by which the fortunes were made and the fortunes disappeared, and the really smart guys are buying when there's blood in the streets, the Warren Buffetts, and knowing when to sell makes you a lot more money than knowing when to buy. Amazing book, absolutely amazing book. And the world that he was describing then has so many parallels to the way the world of investing works in 2025. It's an interesting read.
It's another parable we have here is like about human nature. You can't change human nature.
He was an honest observer and reporter about human nature when it comes in contact with fast money.
Yeah.
And that hasn't changed.
Well, we're going to leave it there today.
Great.
And Alan Schwartz has been our guest today, and we hope to have Alan back because he's got a lot of stories stored up in that brain of his. And so, Alan, I hope you enjoyed yourself today on Liars, Cheats, and Thieves and everything in between.
Immensely, and happy to chat with you. Thanks.
Well, thanks so much, and join us again next time here on Liars, Cheats, and Thieves and everything in between. Sarita Patel is still on assignment in Chicago, coming up with some great stories there. Chicago has proven itself yet again to be the heart of Liars, Cheats, and Thieves, and everything in between. Thanks, and we'll see you again. Bye-bye. This show was produced and directed by Latham Woodward for Madmana Studios at 412 Red Hill Avenue, San Anselmo, California, 94960. For more information, please contact us at latham@madmanastudios.com. That's LATHAM at Madmana, MADMANA Studios.com. If you like this type of content, please like and subscribe to Liars, Cheats, and Thieves and Everything in Between channel. We appreciate it. All views expressed are those of the guests on today's show. This has been Madmana Studios and Liars, Cheats, and Thieves, and all things in between. Copyright 2025. All rights reserved.